hours and more than anybody else is a lower bar. That being said, when you think of anybody else, you've got to think about property managers, anybody working on the property. So it could be a contractor, for example, anything like that. Those hours have to be considered.
Awesome, thanks, Chet. And I was a little delayed, sorry guys, just so a heads up, I started recording so we could send this to the rest of the people on the list. So the rest of the questions will be on there. Then we got a question here. So if we don't have reps, what else can we do to reduce taxes with real estate? Good question.
Yeah, it's a great question. Probably the first thing that jumps to mind is just the idea around short-term rentals. And so people immediately hear about real estate professional status, and that's immediately what they go for. There's also, if you have short-term rentals, so short-term rentals being the average rental period of 7 days or less. That's kind of the next one that people look at, with the idea being is that I only have to get to material participation in that activity. I don't necessarily have to hit 50% of my time in 750 hours. So lower bar than rep status. And so a lot of times people look at like Airbnb. And so if you think about 100 hours per week, if I'm managing that property by myself, for example, I have some clients that they'll move into a duplex. They'll move into one side of it and they'll manage the other side of it as an Airbnb, as a way to kind of use real estate to build wealth. That Airbnb side of it, if they're the ones that are turning over the sheets and they're texting people codes to get into the doors, stuff like that, they can actually use that property, the losses in that property, to basically offset their other income. So because real estate tends to generate taxable losses, even if I'm making money on that property, that's another opportunity to basically reduce your taxes with real estate. The other thing that comes to mind is just in terms of maximizing my overall wealth with real estate. If I'm making a ton of money on real estate, I'm cash flow positive, I have a really good rate of return, but I don't have to pay any taxes on that money, that's still a good situation. So for example, if I have a rental property that's the rental revenue is exceeding my the expenses that I'm incurring, real estate taxes, utilities, etc. But I'm able to use depreciation or wear and tear on the building to basically bring that down to zero. I basically have found a way to generate, income that I'm not having to pay taxes on now, at least.
Awesome, thanks, Chet. And then I have another question here, and just a reminder, I didn't say this, so excuse me. If you could drop your questions in the chat instead of the Q&A, that helps me keep everything in one spot. So our next question is, question on disadvantages/advantages on putting primary or secondary home in LLC.
Yeah, great question. For tax purposes, it's truthfully going to be the same in almost every state. There are some states that'll have you, for each LLC, they'll have you have like a license in some situations. So there's something to consider there. But for the most part, that question specifically around risk mitigation. And so you're primarily going to be thinking about how are my assets protected in terms of what does an LLC do for me. The other thing to consider there is around like things like estate planning. And so, to the extent that you're at a place in your life where you've started to build a certain amount of wealth and you're thinking about putting your primary, secondary place into an LLC, I'd talk with your estate planning attorney, if you haven't already, just to think about overall strategy around how do I have risk mitigation, and two, how does that play into my overall estate plan?
Awesome, thanks. And then, so everybody, if you joined in late, feel free to drop your questions in the chat and we'll get to those. I have another question here. What are some of the biggest mistakes people make when they jump into real estate investing?
Yeah, I would say that probably the biggest mistake that comes to mind right off the bat is just not truthfully having a strategy or a plan in place around real estate. And specifically that plan should be tied to goals and kind of what's realistic for your lifestyle. So a lot of the times people are first coming across real estate with the idea of they'll hear it from a friend or a colleague or something like that. Yeah, I've got this real estate investments and I'm not paying anything in taxes. That's maybe true, but there's possibly more to it than that. And so really each person's situation with real estate is different and really should be looked at on a different case-by-case basis. Also just relative to everybody's goals, everybody's priorities may be a little bit different, and your situation is probably very different. And so probably the biggest mistake is just hopping into it, buying properties without really thinking about it or working with somebody to kind of think about how this plays into your overall financial strategy, your goals, your priorities. Is this something that's ultimately getting you closer to the things you want is really what you should be doing.
Awesome, thanks, Chet. And then we got a follow-up question to the LLC questions previously. So concerned about capital gains advantage, 500,000 that you lose if you put primary home in an LLC, question mark.
Yeah, that's a great question. So just putting the home into an LLC in and of itself isn't going to exclude you from you're not going to miss out on that 500K gain exclusion that's available for primary residence. Now it depends on the underlying, like maybe there's an underlying question there. So if it's I'm flipping a primary home to a rental property and that's going to be in an LLC and I'm going to use that, there's maybe some strategies there and some things to consider around the 500K gain exclusion. The other thing that would probably be worthwhile exploring in that person's situation would be the idea around what is it that you intend to do with real estate, because if the idea is that property I'm probably never going to sell it, it's a good rental property for me, or I'm really trying to go the real estate route, it might be a situation where that 500K gain exclusion becomes moot, in the sense of if you're just going to acquire a bunch of properties and really you're just trying to build your real estate portfolio, you're probably going to use a bunch of things like 1031 exchanges, some more advanced tax strategies anyways to defer gain long term. So certainly not something to not consider, but maybe less of a consideration if you factor in your overall plan and what you're really trying to do with real estate.
Awesome, thanks, Jeff. Any other questions, everybody? Feel free to drop them in the chat. We'll wait a couple minutes to see what comes in. I know, Chet, I wasn't asked this specifically, but I think getting later in the year, and it's coming up in a number of our conversations about the short, oh, here we go. Could you explain more about doing a cost segregation study?
Yeah, absolutely. Yeah, that's a great question. So probably the first thing that comes to mind on a cost segregation study is like, so what is a cost segregation study? I'll start there. It's the idea that basically when you have an investment property, you can depreciate or basically clear wear and tear expense on the value of the building. The IRS has arbitrary rules for that, as to like how long, like basically how much depreciation or wear and tear expense do I get on the building each year. And so for residential property, that's 27.5 years. For commercial property, that's 39. So long story short there, basically I can write off the value of the building over a really long period of time. And so the reason that the cost segregation study comes into play is because with the cost segregation study, there are some items that we can find within a building. So examples would be like, there's a driveway, that's a land improvement, not necessarily like something that's attached to the building, it's not part of the building structure. Like furniture or anything within the building that you bought. So if you bought, within the building, most of the time there's a fridge or there's other sorts of appliances, things like that within the building that aren't necessarily structural to the building. And so the reason that's relevant is that stuff we can potentially claim what's called bonus depreciation and write off the full value of that in the year you purchase it. So probably the rule of thumb I always hear with cost segregation studies is typically 20 to 25% of the cost of the building, not what you put down. So the cost of the actual building can be written off via a cost segregation study. And so basically you hire an engineer, they go out there, they put together a report for you that says, here's what the cost of all of these other items are that we can write off right now. And so it's a way to accelerate the expense when you buy investment properties. The one caveat that I would have on a cost segregation study is don't do a cost segregation study unless you either A, hit rep status, or B, you have a short-term rental situation, which I alluded to at the beginning of this, which is I have material participation in a short-term rental. And even then, that's probably something you should be talking about with your CPA, just to make sure that that you're basically going to get the benefit. And I say that because I've seen a lot of people do cost segregation studies. It's usually an expensive investment to have somebody come out. So you're only going to do that if you're actually going to save way more money than what you're paying. So I see a lot of people who do a cost segregation study and not get the benefit from it because they don't hit reps, they don't hit material participation, something happens. And so if you're going to do that, probably something to discuss with your advisors, kind of your overall tax plan.
Awesome.
Hey, Chet. On that one too, I know we've advised clients against doing the cost segregation studies if they're going to do kind of a quick turnaround on that property. What's your idea of the kind of the best timeline? How long should somebody intend to hold a property if they're going to do a cost segregation study?
Yeah. My thought is really that one. It depends. So I could have somebody, for example, I just worked through a client more recently who they're maybe only going to hold this property for a year, but the reality is their income bracket in this year where they're going to hit reps or material participation is 37%. Next year they're retiring, and that's going to fall off a lot. And so really the whole exercise behind doing their cost segregation study in that particular case is that they're going to go shift. Basically, they're going to shift some income from a 37% bracket down to a 22% bracket. So they're basically on 150 grand, they're going to save 15% of that. So it's a nice chunk of change. And so for most people, you're probably going to hold that long term. But there are some situations, in my opinion, at least that short-term strategies that can play out. Any thoughts?
Yeah, no, that makes sense. I think if you have a big change in income year over year, that may be a good strategy. If you're in the boat where you're going to continue to work and your non-real estate income is probably going to stay pretty consistent year over year. If this isn't a property that you're going to hold for more than a few years, it may not make sense to do that cost segregation study, simply because you're ultimately going to see that benefit when you sell that property. And if you go through the cost and the time of doing the cost segregation study, and then you sell that property in a couple of years, you're going to get hit with something called depreciation recapture on a big chunk of what you took through the cost segregation study. And so you may end up in sort of a almost a wash position on taking that study if you sell that property. Yeah, probably not the common thing for people that are investing in real estate, but just something to keep in mind. Do you have any other questions, Zach? I have something else we can jump on.
We have two, yeah, in the question here. So if I am on a W-2 and medical premiums are through the employer, I pay around $12K per year. Can my real estate LLC help me shelter some of that expense?
Some of the expense related to the medical premiums.
Hey, Chet, I got one on that.
Yeah.
So if your employer is covering even a portion of your medical benefits, those are the amount that you're coming out of pocket for is not going to qualify for a deduction through another business. That's one of the carve-outs that the IRS has.
The only other, oh, go ahead.
No, I was just going to say, if you were covering this cost yourself and your employer wasn't covering any portion of it, then certainly there could be some room there to get some benefit. But yeah, there's basically a carve-out that says if the employer is providing any sort of reimbursement or covering all or a portion of the cost, you lose out on some of these other opportunities to see benefit for that.
Yeah, somewhat related to that. The only other thing that, again, somewhat related to that I've seen people do strategically around medical expenses is in some situations it can make sense to set up actually called a C corporation, and that's simply because you can set up certain types of employee benefit plans, such as a health savings account for the family. So depending upon what your long-term strategies are, what your kind of average medical expenses are, what your individual situation looks like, potentially a situation which we set up an entity that has a specific purpose. Maybe it's a family management company or something something that manages your wealth, that specifically has special types of employee benefits, a way for you to get a deduction or basically have some tax-free benefits to deductions and health expenses.
Awesome. And then if I have a 2-member real estate LLC and file partnership returns, and then I get a K1, can my loss be considered active?
Member real estate LLC. Can my loss be considered active? They could be. Yep.
Yeah, so on that one, it's going to go back to the same test that we looked at for reps in the beginning. So 1, do you have rep status? Have you met the 750 hours test? And then 2, do you have material participation in that activity? So you have to be able to hit that. One of those 7 tests that we mentioned, usually people are going to meet either the 500 hours or the 100 hours in more than anybody else. If you can say yes to either of those, then you can kind of push those losses through as active under the real estate professional rules.
Cool. So that's the end of the questions here. Kyle, did you say you had something you wanted to chat about?
Yeah, just Chet, earlier you mentioned 1031 exchanges or like-kind exchanges as an opportunity to defer tax. Can you talk a little bit more about when that strategy makes sense, or some times that our clients have used that to kind of better their real estate portfolio?
Yeah. So the most common situation is basically, maybe I started with real estate. Probably the most common situation is I flipped a personal property that I used to own into a real estate investment, simply because I moved and it seemed like I wanted to get into real estate, and I might as well see if I can make some money on this property. So people will do that. Later, when they start looking at kind of the rate of return, or maybe they bought a property that they thought was going to do well and it just doesn't, which does happen. They'll look at it and say, like, yeah, I don't like this market. I want to go somewhere else with my real estate investment where I think my dollars are going to go further, or or maybe I want to upgrade. Maybe I have a small property and I want to get into commercial real estate. What you can do is through a cost segregation or a 1031 exchange is basically, as long as for the most part you're rolling your investment into a new real estate property, you're typically not going to pay any tax on whatever gains you've built on that particular property. So if I bought a property for $90,000, it's worth $200,000 now. I don't think it's generating a good rate of return for me. Like, I'm just not making the same amount of money as I would elsewhere. And I want to roll that investment into something else without having to pay tax on that $110,000 gain that I have. I'll use a 1031 exchange. There's companies, basically you hire a company to help you facilitate this transaction. And you basically can defer the gain that you have. So it's kind of unique to real estate. It's not like I can sell Google and buy Apple and avoid a gain on the tax from doing that. Whereas I can do that within real estate. So kind of unique aspect to real estate. The one other one that I think not a lot of people know about is, oh crap, I've sold an investment property. I now realize I've got a huge gain. And so there's potentially an opportunity there to still do a 1031 exchange, as long as you're doing it within a certain time frame.
Awesome. And then a couple more questions here. I was listening to a Bigger Pockets podcast, and the person being interviewed said they get a W-9 form from all the contractors that work on their properties. Is that something we need to do for anyone working on our rental properties?
Yeah, I'd get it from anybody performing services on your rental properties. And so the general rule there is anybody performing services, basically, if you're paying them $600 or more in a particular year for services, you have to issue them a 1099. And so what a lot of people don't think about is once you have a rental property, you're kind of a business owner in the sense. And as a business owner, you now have a requirement to collect W-9s from everybody and then issue them a 1099 annually. And so typically that's done in January every single year. If somebody's a corporation, there's a box on the W-9 that says corporation. You don't have to issue them a 1099. But yeah, you should be getting it from everyone.
Awesome. A couple more questions. Can hard money interest, points, fees, down payment be expensed?
Hard money down. Yeah, so if I'm actually putting money down on the particular property, that basically what's great about real estate is not just what I put down, it's what the cost of the building is. That's what gets to be depreciated or goes into the calculation. In terms of points, that's typically over the life of the loan, like in an investment situation. That's typically how that's deducted. So if I have a 30-year loan, typically I'm deducting points over 30 years. And usually fees get added into the cost basis of the property. And so whatever our depreciation life cycle is, 27.5 or 39 years, that's how that gets deducted.
Awesome, thanks, Chad. So this question I may need some clarification on, but it says, so I think it's either what do you look for in a company that does 1031 exchanges, or how do you find a company that does 1031 exchanges? Maybe answer both if you have an answer.
Yeah. So I have a really good company in our network. For anybody who's interested, we've interviewed a lot of different 1031 exchange companies by the nature of working with a lot of them. In terms of what to look for, experience, honestly, it's more subjective than anything in terms of just based on experience working with a couple of high tier companies. They tend to work through 1031 exchanges pretty quickly. And then they tend to execute at a pretty fast pace. And so hopefully that answers your question. I guess I don't necessarily have a set of criteria other than we found companies that we really like based on just their ability to answer questions quickly, their overall knowledge around 1031 exchanges, just kind of based on our own professional opinion.
Awesome, thanks, Chet. Then the other one was, so a clarification on the 1099. To clarify, if they are a corporation, you don't have to get a W-9 and send a 1099.
Yeah, you'd still want to get the W-9 from them, and that's because the W-9 is your proof to the IRS that they were a corporation and you didn't have to issue them a 1099. The other pro tip on that is I'd get it before you pay them, simply because in a lot of contractor roles, a lot of people truthfully they don't want to deal with the paperwork side of things, and so it's a lot harder to track them down to get that if you've already given them payment.
Cool. Well, unless there's any other questions, guys, I think that's the list we have for today. I'll send this out to the other folks that had mentioned they were interested but couldn't make it. Any final words, Chet or Kyle?
No, thanks everybody for coming prepared with the questions. Those were great. If you have any other questions, feel free to reach out to Zach, and we'd love an opportunity to explore a relationship with you further.
Cool. Thanks, guys.
Thanks. Have a good one.
Bye.